Okay, hello everyone and welcome to BFW 2401. This is workshop for bank performance. There is always, I said, workshop every week, except some of the weeks are allocated for the tests. So now I want you to log into Bull Everywhere, and also at the same time, I want you to download the solution of the workshop and add your notes as we progress. If there is any question, just share or tell me, okay? Now, this is workshop 4, and this is my agenda. Anyone please ask for annotations so I can approve here? So you can see my words written. Anyone from your side request for annotation? Like this one, I'm really allowing you to. Okay, so this is actually the, as I told you, workshop 4, and we are talking about bank performance, and this is my agenda. We want to talk about the part 1. We will have some MCQs questions, but then we will talk about the financial ratios. Now, all the solution is with you. The data also is with you. So what I will do is I will go over it. Now, I think this workshop will be good for you because I added some slides. For example, these slides will tell you the whole issue of bank performance. So we have internal indicators and we have external indicators. And when we say internal, this is the summary of the whole thing of these framework of the bank performance framework. So in the internal indicator, we have qualitative one and we have the quantitative one. And the quantitative one simply is the ROE model, which is the financial ratios, and the risk ratios. So we have the ROE is the financial ratios like the ROE, ROA, ROE. We are talking about PM, which is the profit margin, the asset utilization, and also the profit margin, and also the ROA, which is the return on assets. And then we have risk. And then when we talk about risk, we talk about all those risks. We talk about capital risk, we talk about liquidity risk, market risk, OPS risk, all those type of risks. Plus, we have efficiency ratios, and we have what we call interest rate differential. All of those ratios, all the formulas are slides, and if you see this in the exam, just please try to use them and apply them. Now, in the external ones, we have all those questions. Something about the whether we have products and services like we have ATM machine, we have internet banking, we have all those issues, and also we have all those type of loans, of deposits. This is when we say the range of services and products. And also we want to see whether we have a good internal planning. We want to see also whether our staff quality is good in terms of servicing the customers. This is the internal one, and the external ones actually is the perceptions of the investors, the public, and the shareholders. But we have also external quantitative, which is out of the balance sheet and the income statement and the internal records, which is actually, you can talk about the You can talk about the market share, you can talk about share price, you can talk about the value at risk, which means how much risk we have. You can talk about the DA ratio, which is the share price. You can talk also about the small ones, rating agencies here, and we can talk, as I told you, about the market share. Now, this can be, you can map your thinking towards this bank performance in general, and you can divide it to internal and external, and then the internal and external can be also divided to quantitative and qualitative. But the notes that I want you to look, or the observations, is qualitative external measures are very important for banks. When we talk about qualitative external measures, which is the perceptions, actually, the perceptions of the public and our contributions, for example, in the environment, and whether we are providing loans to those companies and individuals who are hurting the economy, whether we are participating in the environment and the social issue. So all those issues are very important to bring a good perception. So this is very important, which is all those issues. Now, this is very important more than when we do, for example, for corporates, if we have an oil company, or if we have a, auto manufacturing company like Proton or Mercedes, whatever, we wouldn't be actually, we care about the product, but not how we perceive what they do. Okay, so in this case, because we are putting our money in a bank and we want to have more trust, which we call it trust economy. The second issue is the qualitative analysis. If we are doing in this qualitative analysis, actually, we should be doing well in the quantitative, which means there is a validation here. So those validation, which means if you look here, if you have good products internally, if you have good planning, if you have good staff, if the perception is about you is okay, the regulators are happy with you, all of those issues should be reflected on the share price, the market share, the what we call the earning, and also it should be reflected also in those issues, which is the financial ratios, the ROE ratios, and the other ratios. Now, if you come and you want to talk about, if you want to talk now about analysis, assuming you are working in one of those big four, or working or an investor, or working for, as with one of those big financial analyst places. There is so many financial analysts who can make analysis of a company or more than one company, and produce those reports to the market and to the investors. So in this case, you will have, that if you analyzing few banks, the purpose is to maximize the shareholders' wealth. And to answer this question, whether you are actually maximizing the shareholders' wealth, then in this case, you have to do some analysis. And those analysis is, you have to collect data, which is external and internal data. Then you have to calculate what we call the financial ratios data, which is the ROE, the risk measures, all those ratios. And you have to look at linkages with those ratios. When you compare them with the peers, which means how the industry is doing, with the targets, and with your trend, which means how did you do last year according to this year, and also what was your target, and also how the other people or the other company, other banks in your area doing. This is how the financial analysts work. So if you talk about, for example, the financial analysis, so you have an effective analysis should take the financial ratios, which is actually the ROE, the off-balance sheet indicators, and the share market data, qualitative performance inside and outside, and indicators of each, for example, of business units. For example, if you are a conglomerate, one of those big banks like public banks or May banks, or you have insurance subsidiary, you have what you call retail subsidiary, you have what we call offshore subsidiary, you have Islamic subsidiary. You want to see how all those units doing individually and how much they contribute to the full, what we call income of the bank as a conglomerate or as a group. And therefore, as I told you, when we do those, all those data, you have to compare it with your trend. How do you do it based on last year and the peers, and also you have to compare it with the peer, with the trend. How do you do last year? How do you do compare to the industry average? And how do you do according to your targets, which is a benchmark? And then if there is big differences, you have to look for linkages if there is big differences. Now, the way, jump, or if there is a jump, big jump or big fall, then you have to see where it comes from. And this is actually how, this is the full picture, which is coming here, and this is slide, this is slide, this is slide. Now, I want to test your understanding, and I want you to now to go to the pool everywhere, and let's start with some questions to see how you're understanding and this issue. So I will go to, and I want everybody to participate. Please log into pool everywhere. It's in the chat, and you can just start quickly. And I want to see how is your understanding before we go to our questions. So this is actually. And I want to go to workshop number 4, and this is the workshop. And let me start with the warm-up questions, and I am playing. Who is interested in bank performance? Please log in. Is it the bank management, the regulators, the shareholders, competitors who wants to take us over? We have 51 students. Please participate. No problem if you don't get it. But those people will look at our, the answer is 88% of the students say yes. Now, again, as I told you before, when you read, please read every single option. People who choose the regulator, they are not wrong. It's part of it. Shareholders are interested to see our performance. Like, as I told you, who wants to invest in us, so they want to see our performance. Bank management also do it. They need it also for planning. They need what we did. Who is the one who is going to, they do it inside, and they look at how did they do according to what they did last year. They need to report, they need to do all these things. Competitors also, the one who choose competitors actually a very smart also person, because in this free economy, what we call free market economy, we have to provide information if there is mergers or acquisitions. And when we make big banks, it's very important. Yes, it's hard for us as a bank, but when somebody come and take big banks, it's good for the economy, good also for the insiders, good for everything when you have huge banks. We used in this country to be 36 banks before the Asian financial crisis. Now we have only 9 big banks. So the question is all of the above. Now, regulators are interested in bank performance. Why? To invest in us or to do something else?
Yeah.
Do they want to control us and to see how to, protect the economy, or they want to invest in our bank? Regulators like Bank Ligara, Reserve Bank of Australia, all those people, scary people, not really scary, but we have to comply with them. Oh, somebody have a chat here and saying, is there someone who is unmuted? Their voice. Oh my God. I am okay here. Everybody can hear me or no? So I think people who are muted, they have, please check your, this voice has covered. Someone who is unmuted, please, if there is anybody unmuted, please. Now I don't know whether you did this question or no, but 67% of it say yes. So I think we solved the problem with the voice, right? If anybody, I cannot see anybody. Please, if you are not muted, muted. Oh, actually, this is another issue. It's okay now. Okay. Okay, thank you very much. Now let's just continue. Okay. So just come back to here. People who choose 33%, the central bank and regulators are not interested in our performance because we report to them every 3 months, every 1 month sometimes. Sometimes they come, they just want to see that we have good control of the risk. Because if we fail, we will hurt the economy. And regulators supervise us for this purpose, to see whether we are doing well. So they are not actually interested to invest in us. They are interested to watch us, to see that we are actually operating well. Please write this note. The regulators are interested to supervise and to control the systematic risk through assuring that the bank is performing well and controlling the risk so they don't fail and damage the economy. Okay. A public perception is one of the external qualitative bank performance measures and can be measured via surveys, which means how do I know the investor, how do they lie? I don't have data. I have to send some survey and said, what do you think of the bank survey? Or do you think of all those issues? So please participate now, 93%. %, yes. Okay, let's go to the next one. Thank you, Sumail. Just 0.25. The concept of optimizing risk, and this is a very risky, not really risky question. It's a good question. But when we increase the risk, do we want just to make, I mean, when we optimize, do we need to maximize the return? Because return goes to the risk. So we have to reach to a point where risk and return give us the most shareholders wealth. So is this statement true or false? Wow, yeah, this actually I need to talk about it a little bit. I'm sorry, but this is very important for me and also for you. I will come back to this. I think please look at this slide. If you want to increase the value of the bank, there is return, and this return, we have talked about this. This return can just go up, 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 but we take this, and it's linear. We take this quadratic, what we call. This is very important for me for you to. If it is return, it will be like this. But actually, we take the risk, which is this one, and the return. And therefore, we don't take this red thing. We take this quadratic, not this linear equation, because we want to increase the risk as we increase the return. But we cannot, because if we look at this here, and we continue, see how much risk we have now? Too much risk here. The risk will be here. No, we want, but if you look at this the formula, which is a quadratic one, yes, we increase the risk and return, but the damage from the risk is higher than the profit from the return, and therefore the impact of the shareholders' wealth started to drop. No, I want to bring it here. So when I say maximizing the shareholders' wealth, it's this point, which actually balance between the risk and the return. This is the optimum position. I'm not talking about a return that will go up to here. No, we are going to a place where, because this formula, if you look, it's the return minus the risk. And we want the value of the bank to increase. So if I'm going to increase the return increase, and the risk increasing in a way that the damage from the risk, overcome the profit from the return, this value will drop as it drops here. So please understand this. It's not maximizing the return. Okay. So let me just go now. Play, and I will just play anyway. I think we have done this, we have done this, we have done this, we have done this, we have done this. We have done this, we have done public perception is one of the external. I think we have done this. The concept of optimizing, this is what the one I'm talking about. Please go ahead and do it. Is this a statement, do we just maximize return or we look for optimum? Please participate. Some of you are shy to participate because they think, oh, if we participate, maybe actually 88%. It's false. Maybe the next one, who is this smiling? I need you to see your name sometimes because I can review this in the finance or wherever. I say this guy was always with me. Now, this is just related to other statements. The concept of optimizing risk and return will lead to the optimal shareholders' value. Is this correct? When I optimize, which means I choose the best risk that will give me the maximum return for that risk. Think about the quadratic formula I show you. 84% is true. And as I told you, This is true because this reflects the graph which I show you, the optimization. When you have the optimum, you can look at that, what do you call it, that slides I just show you. Okay. Now, I want you to note that this is the relationship between quantitative and qualitative. Not Maybank. This is not Maybank. It's your bank, the bank that you are working with. It has all these services. It has everything. And I want to conclude whether its market and its market share is going. And is there now a convergence between quantitative and qualitative? My bank should be profitable. My bank should have better profile in the stock market. Or maybe all of the above. Yes, I like it. Now, people who choose my bank should have better profile. Yes, I agree with you. Quality products, I agree with you. My bank is more profitable, I agree with you. But actually, it's all this. Remember, please, the golden rule. The golden rule is you have to read all of them and see whether all of them make sense to you. Okay, let's go to this one. BE, this is the price to earning. Market share, credit rating, and ROE are all external performance. Is this right or not? This will reflect your understanding of the internal and external. $73 didn't get it. See, BE is part of it. This is the share price. BE, this is the price to the earning, which is actually, you can say it's external. Market share is also external. Credit rating, those agencies who rate us, all of those people are external. But the ROE is based on the income statement and the balance sheet. And therefore, it's internal. So when I come and say all of them are external, it's not right. Some of them quantitative internal, some of them quantitative external. The BE is quantitative external. Also, the E can be internal, but the price is internal, external, market share external, credit rating external, ROE internal. And therefore, this is just to reflect your understanding between the internal and external. Okay. Financial analyst reports are supplementary information and can suggest buy, sell, and hold. Now, if you don't answer this question, that's fine with me. It's very fine with me because I just give it for you to understand. This is what financial analysts do. Oh, you already know it. Thank you. And you can see it in the slides I gave you, the first 3 slides. Now, this is the last question, and I want to celebrate those people. Who is S? Guest 97. I don't know you guys. So, some of the names I can know. You are so shy. You don't want even to show your friends who you are. Okay. Okay, let me just skip this one. Now, let me go to this is just to explain to you this is how the market works. And this is what the brokers do. This is for the 7%. So, you know, the financial analyst will tell you if this is the market price goes up and down. And the green one, they will tell you they already know. And this point, which is June 1st, they know the price will go up. If they are going to give you any advice, they will tell you buy now because they know the price is going up. And they know here is the peak of it. So they will tell you sell now and wait until here and buy. So actually they tell you strong sell or hold. They don't know. For example, here hold. The market is very stable. We don't know. You know, there is nothing. But here there is this volatility and they can tell you. A smart financial analyst, hopefully it will be you in the future, can suggest from strongly buy to strongly sell. Now, I want you to look at this. This is how they do at the brokers. Most of them will ask you also to do that, and the financial, if they are smart, and the financial analyst also will give you this. Now, I want you to look at the data. Now, the data is from the, this is the questions now, because we finished we finished the what we call the pool everywhere. But this one also is pool everywhere. I want to look at it and I want to ask you. So these questions, for example, this is the data I get from the Excel file, 2011, 2010, and I am taking a big group here, CIMB. This data 2002, because this is the one I get from BankScope before they discontinue it. This is a database. Anyways, I try to calculate the ROE model, and the ROE model, one of the things is to compare between the years. As I told you, I compare between peers, targets, and trend. This is like trend. How did they do in 2011 and 2010? And based on that, I raise some questions. If there is big jump or drop, and try to get linkages. So I calculate for you this one, which you can calculate easy. And you can see the ROE, the ROA, the LM. This is all the component of the. So my question is, if you look at this data, my friends, let me ask you this question. Based on the ROI model for this guy, CIMB, do you see any external change? Do you see, look at it. Is there extreme changes between the two? I already calculated for you. Oh, 100%. Well, 29. You are scaring me. It's a matter of perspective, you know, but are we done with this? Where is this thing now? Actually, if you look at it, Just give me a minute. I think this is your answers. Mhm. And I think there is no big difference. I don't see a big difference actually between, there is no big ones. If you look at them, this is the 16, 12 or the ROE. This is almost the same. We are not talking about big change. So I can say I don't notice a big change between the two. This is almost the same, the AU. This is almost close, the profit margin. But this is still, you know, a little perspective, and actually you don't have enough information to dig more. But from there is no that huge change. Okay, let me now go to. Please look at the second one. About bank efficiency. Now, if you look at bank efficiency, you can still if you look at the bank efficiency with this one, actually based on the data provided, CIMB is showing positive results, but the conclusion about the performance is actually in those ratios need comparison with trends, peers, and targets. Yes, I'm doing this is I just calculated, but I don't know. I need to compare it. I need to know it's 1.57. I don't know that 1.57 is high or low. Is it better than last year? Is it worse than last year? Is it like other banks? Is it less than the other banks? So actually the answer is, based on this, I cannot say it's profitable. I cannot say it's profitable. I just know that there is a ratio. And this is why we have to get this framework of getting the data, correct data, and then compare them with targets, peers, and trends. So you have to calculate it. Now, interest differential, as you can see, we have doing here 2.64. He's 1.57. Still, yes, we are making profits, We are making percentage of interest between the interest paid and interest income percentages. We have 264, which is better, which is good, but we also need to see how we are doing comparing to the other ones, to the other to our target and to our peers and to our performance last year, which is the trend. So all those questions is you need actually to compare. Now, the asset quality, what do you think of the asset quality? See, the asset quality, which means the loan sales, the loan reserve, which means how much we reserve over the gross loans, is it increasing or decreasing? This is 2005, 2006, 7, 8. Is it going down or up? And is this good or bad? This is why I want you to understand how we manage them. So best of the data for this one, are we doing bad or good? Anybody else? Actually, we are doing well. And we are doing well, why? We are doing well because if you can see here, it's dropping, which means how much loan reserves? Loan reserves is actually give me the loan loss reserves is those loans which we expect not to collect. And this is why we make a reserve for it. So you can see in 2005, it was 5.43 out of the total loans. This is an indicator of credit risk. But then dropped to 572, goes to 572, 572, but then continue the trend of dropping until it becomes to 313. So when you say it is dropping, actually, and it's good, yes, they are controlling, they are going well and controlling their credit risk over the years. They are improving. Okay, let's go to the next question. Now, if you look at this one, what do you think of the liquidity ratio? And the answer is here, actually. So the liquidity ratio, please write it, it's between 7 to 10%. And when we say 7 to 10%, these people are holding too much liquidity, which is not really good. Which is not really good. They are not efficient. In other words, you can write a note here, they are not efficient. In Australia, it's 8%, here between 5 to 7% in this country. But when you hold as cash and liquid assets, like 29%, 81, this seems to be securities, short-term securities, which give just a little bit of return. You need to have more than that. Anyways, when we talk about liquidity, this is the normal ratios, but sometimes you have to dig for more information why they are doing this. Now, if I come to the next question, and the question is the capital risk. Now, if the capital risk is, if the total ratio, according to Basel III, is 10.5%, and the Simber ratio, now it was during those years were 8% actually, and the Simber ratio is 4.5. This is what we should have. As you can see now, if I have 8%, this is what I should have, and 4.5%, what I should have for the Simber ratio, 4.5, and for the total capital, 8% before 2013. This is up to 2011. It looks like this bank is doing well. They have enough capital. It's not bad. It's not bad. I mean, at least they are not conflicting or below the regulations. Maybe they are holding more capital and it could be more, not efficiency, but in terms of regulators, it's a cut answer. They are satisfying the capital ratio. And they are, there's insolvency risk is less. Now, let's come to here. OPS. OPS is all these operations out of the balance sheet. So in the US and Australia, you can find it 543%. In the US, you can find it more than that. About, it reached to 2000% during the financial crisis. For CIMB, it's just 30%, 24% of the total business, of the total assets. The answer for this is Malaysian, especially when it comes to derivatives. It's a Malaysian environment. They don't have a lot of derivatives operations. And in this case, you cannot tell whether this is high or low. You need to dig. And as I told you, compare to the trends, the peers, and also the targets. So in this case, there is no indicator. This number give you no indicator unless you dig more. But if you want to compare it with other countries, it's not a valid comparison. Okay, now let's go to the most important thing, the PA ratios. Now the PA ratios, I discussed it in the tutorial. I just give you some data here. The thing of the BA ratio, the BA ratio is actually you divide the profit, the price of the shares over the earning of the share, which we call it the earning, we call it earning per share. E stands for earning per share. And the earning per share is actually the net income over the outstanding shares. And we need this to be higher. We need it to be higher. We need it to be actually higher. Now, if somebody is giving me earning per share of 1, and its share price is 10, and somebody is giving me 1 earning per share, but the price is 15, that means because the share price is actually reflects the future information, the potential of the growth. And therefore, as an investor, I'm willing to pay 15. So if any bank has a PE ratio, which is 1 over E, that is higher, then in this case, the market is perceiving it to be a high growth bank. Look at the data which is collected from 2006 to 2021 for CIMB Group. It's 2.87. This is the PA ratio for all those years. But the industry or the average of the other banks is actually higher. Actually, I am not receiving CIMB to outperform the peers or the market. They are always below. Even if you take to the average 21, it's 4.3, while other banks average is 10.21. So the question is actually, if this is, for example, like 15, then I would tell you, yes, they are, the growth of CIMB is higher or there is a potential. But it looks like other banks are doing better than CIMB, which is the other banks. This is the average of 4 big banks. I take it from the results. So please write these notes. CIMB market expectation is less than the average industry banks. The growth could be lower. Okay. Now, this is one thing. The other thing is, I have only 6 minutes and hopefully I can finish. I didn't finish the VAR. The VAR is actually will take a time. This is a market ratio, a market indicator, and it tells you the volatility of your the prices of your investment in the market, and we use it like the VAR. So you have here, if there is, in the middle here, actually, if in the middle here, and I want you to if the middle here, this is the middle, okay? This is the middle, which is the average. This is a distribution of the price. If this is 100 million, and then my investment price can go to, say, more than 100 million, 100 million, 110 million, 120 million, or it can go to 90 million, whatever. So I will take all the prices of or the return of my investment, and I see how it works, where it is. This area from here, the losses up to here is actually what we call it VAR. Please write it in your there. This is the value at rest. This is the values what we expect the drop. And therefore, we need to measure this one. And we see what is the value at risk. So in this case, this is how we explain it. And therefore, I use the data, which I show you, data which I wrote for you here. The data, you can calculate it very easy. The data, you can calculate it very easy. So if I take, for example, the closing rate, the closing price by day for one of those banks, which is CIMB, and get the share price between one day and the other, and try to see an investment of 1 million, I can calculate actually the expected volatility, which is the standard deviation of the price, the standard deviation of the price, which is actually this one. And if you can, you know, as I show you on the Excel file, it can show you, if you can calculate the mean, you can calculate the median, you can calculate the standard deviation, you can calculate the variance and the minimum and the maximum of the price of those observations. And then you have a confidence level. You can have a confidence level of 99%. You can have a 95%. So if you have an investment of 1 million, with this data of this movement of the price, create this standard deviation for 10 days. And if you want to calculate the VAR for 10 days, under 99%, you will find the VAR to be, this is 1 million. So the VAR is 103, which is an expected drop is 103,000. So if you take the fluctuations here, then it can take to, so if you take this and make it, for example, 0.95%, now the price, this one will drop to 73%. If you just want to take 90%, the VAR will drop to 57,000. If you want to very high confidence, as I told you, the 99%, then it can be 13,000. This is when we talk about, the VAR. So the VAR actually, this is just the data I bring it from the, so they'll have the mean, the median. This is the data I get from the Excel file, which I uploaded for you. Now you can calculate actually the VAR for 1 day, for 5 days, for 1 day, and you take the position, which is the 1 million, the 100 million, adverse volatility, which is the standard deviation, square root of the adjusted time, which is how many days. So we are taking 1 day. This is 1 million. This is the standard deviation, the volatility. The adverse volatility is the standard deviation times the confidence level, which is 2.33 for the 99%, and the square root of 1 day over 225. And I find this is the losses for 1 day. This is the losses, the VAR for 1 day. This is the VAR for 1 day. This is the VAR for 5 days. This is the VAR for 10 days, which I calculated for you. And then you can actually play with the Z value of 90% or 95%. Now you understand that if it is 90%, it's 164. If it is 95%, it is 196. If it is 99%, it's 233. This is how we do it. I am done actually today, and this is actually the last question. You don't have to worry about the VAR. I'm not going to give you calculation in the VAR, as I will explain it to you, but I want you to understand that the VAR is actually the measure. I'm done for today, and thank you very much. You can stay if you have any questions. You are free to go now. Thank you very much and have a great day. So is there any questions, guys? Any questions? Tan, you, pick one. Okay.